Okay, thanks for all coming along. This is obviously the Liberal Democrats ALTA, which is the Land Valuation Tax Group. It's the London section of ALTA. What we've done is we've put together three main elements of economic policy tonight to have a discussion with the supporters of those various groups. ALTA, the ER of ALTA stands for economic reform. Obviously people associate ALTA with land valuation tax. And economic reform covers a number of areas, but banking reform is one area which we have positive money and Dyson to speak, and also the citizens' dividends, another area of importance for people interested in land valuation taxation. So what we have today is like a three-in-one, a three for the price of one, basically. You can find, those of you who don't know about these policy aids will be able to get them all in one go. So obviously people who support land valuation tax don't necessarily support a citizen's dividend. They might think the money should be held by the government. People who support banking reform don't necessarily think that it's necessary to also tax land. So what we hope to do today is see where the crossover is between the various ideas, and also get some comments from the various speakers about that. The format's going to be, we're going to have 15 minutes from positive money first of all, explaining about banking reform, then 15 minutes about land valuation tax, and then we're going to have Lembit giving us 15 minutes on the citizen dividend. And then you'll have a chance to ask questions. We'll certainly be looking at what the speakers think about the other speakers' comments, and then we'll have some comments from the floor as well, questions from the floor, and it will be wrapped up in somewhere between an hour and a quarter and an hour and a half. So if I could get started with Ben, could you give him a warm reception?
A key question that we should be asking, that we don't ask very often: where does money come from? And most people have never really given this any thought, but when you ask the question, there seems to be an obvious answer, which is if you take a £5 or £10 note out of your wallet and look on the side, you'll see the words the Bank of England. So when we think about it, most of us assume that the vast majority of we assume that all money comes from the Bank of England. You know, if you print your own money at home, you can expect the police to come through the door at 2 AM the next day. But there's a twist in the story, because only a small percentage of all the money that exists is created by the Bank of England. And in fact, only 3% of all money is created by the Bank of England. So the question is, where does the other 97% come from? And the answer to that question is that the vast majority of all the money that exists is actually created by banks. And it is just the high street banks that we all know, the Barclays, Lloyds, HBOS, the ones that we're very familiar with, that actually create the vast majority of all the money that exists in the economy. Now, just quick show of hands, who is this news for? Is this new information for anybody? Okay, so everybody may have heard it before.
The percentages on news.
Okay, right. So, with cash making up just 3% of all the money that exists, and that money being created by the government, the other 97% is created by the banks. And it's created electronically, so it's created through, essentially when you see a number on your computer, on your ATM, that number doesn't represent some pile of money in the bank, it just represents literally a number in a computer system. It's actually an accounting liability. And the liability, in an accounting sense, is a promise of the bank to pay you. So because they can make these promises, they can increase the amount of money in the economy. When they create new money, they do it by making loans. So if you walk into a bank and take out £100,000 to buy some one-bedroom box in London, that money isn't coming from somebody's life savings, it's actually created out of nothing through the process of the accounting that is used to make the loan. Okay. Now, a lot of people when they first hear this find it almost impossible to believe. It just seems so outlandish that we would allow banks to be able to create money out of nothing. So I just want to give you a couple of quotes. One is from Martin Wolf, who is the Chief Economics Editor of the Financial Times, who was also on the government's Independent Commission on Banking. Martin said that the essence of the contemporary monetary system is the creation of money out of nothing by private banks, often foolish lending. And the other is from the second in command at the Bank of England, a guy called Paul Tucker, who said in the paper, banks make loans by simply increasing the borrowing customer's current account. That is, banks make loans by creating money. Okay. So whenever anybody goes into debt, it creates brand new money and it increases how much money there is in the economy. Now, it might not be that easy to see this, but if you see this green line along the bottom, which is almost flat, that is the amount of cash that has been created by the government and by the state. And this red line, which is just going up and up, that's the amount of money that has been created by the banks. Go ahead.
Sorry, is that M0 and M4 there?
Yes, that's right. Yeah.
And what are the years?
The years are from 1970 through to 2010. So you can see that's almost an exponential increase in the money supply, particularly over the last few years. So now that we know who creates money, we should then think about, who's making the decision about how that money is used. And it's not the junior bank managers in your local bank branch, because those guys don't exist anymore. It tends to be the senior staff at the big banks, the board members, who make the big decisions about whether the bank should be focusing its lending on speculation and property bubbles, or whether it should put some money into small businesses, for example. Now the problem, so what this means is that if you have the senior board members of the big banks deciding where they're going to put the money they create, it's going to go towards whatever will generate the greatest short-term profit for the bank. And that actually means that if you look at what banks actually lend to in the UK, about 92% of all the lending goes to essentially property, so pushing up house prices, speculation on financial markets, and businesses that don't actually contribute anything to GDP, so things like estate agencies and financial businesses. So when you hear the government talking about we need to get growth going again, and we need to get banks lending to help stimulate the economy and give us a recovery, only 8% of all bank lending actually contributes to and fuels growth in the economy. So less than a tenth of all the money that is being lent is actually going to business. Most of it's to property. So I'm going to run briefly through the consequences of this. The first major consequence is on housing. Now, you've probably all heard in the newspapers and down the pub this argument, why are house prices so high? Well, it's because there's too many immigrants and there's not enough houses. Just too many people and not enough houses. But the actual reality is that in the 20 years running up to 2007, the number of people in the country grew by 8% over that entire period. The number of houses grew by 16%. So for every 4 new people in the country, we were building 3 new houses.